Japan is in trouble. Their yen is collapsing as they are trying to maintain yield curve control, and so they intervened to prop up the value of the yen for the first time in decades last week. Now it turns out that the Federal Reserve may be actually assisting them. As Bloomberg points out, Japan may have a pile of dollars it can tap at the Fed's reverse repurchase facility accessible by foreign central banks. However, I think what Bloomberg is talking about here is actually the opposite of what's going on. The reverse repo facility, there is not enough evidence that Japan has any significant amount of money with the Fed. Instead, it looks like the Fed is going to have to be actively assisting Japan with dumping those treasuries using the opposite, the repo facility, specifically the one for foreign central banks. Ready? Let's dive in. Last week, the Bank of Japan started intervening in the currency markets for the first time in decades to prop up their failing yen. As we can see here on the chart, this candlestick is the day where they intervened to buy up yen. But what we know is that for every exchange, something is being bought and something is being sold. And so if they're going to go out into the market to buy yen, they have to buy it with another currency, in this case, dollars. Now, in the video that I made about over the weekend, which I will link at the end so you can understand the full details of that event, I talked about how Japan probably had to sell treasuries to get their hands on enough dollars to intervene on the yen. This is because when we look at the interest rate, the yields on 30-year, 20-year, and 10-year treasuries, we see this giant pop here at the exact moment that they intervened for the yen, but we don't see it anywhere on the 2-year. This would make sense because you are not going to see the Bank of Japan holding the really short dated treasuries. They're going to be holding the longer ones because they're reserve assets. It's not like an institution holding it for basically cash. It's not like a bank using this for cash reserves or something like that. However, Bloomberg is disagreeing with this assessment and saying that Japan has a huge pile of dollars that it can tap before selling treasuries. They say once upon a time, it might have been needed to liquidate treasuries, but not anymore, because the Fed has a reverse repo market for foreign central banks, meaning that the Bank of Japan can keep a big chunk of their cash earning interest there, and when they need that cash, they can just withdraw it from that Fed facility. Here's a longer term chart from the Federal Reserve of this reverse repo facility and how much money is currently inside the reverse repo facility specifically for the foreign institutions. Now, this data hasn't come out yet, at least as of the time of me recording this, because the data is as of Wednesdays. I'm recording this on Monday, and so we do not yet have the ability to see how, if this account was drawn down at all, as dollars might have been withdrawn from this account. So far the logic holds up because there's a repo facility at the Fed specifically for foreign central banks that is there to hold cash reserves so that those central banks can take those dollars out at any time when they need to. But that's where the logic ends here. Bloomberg points off that treasuries did sell off, but it was just because of the bear steepening move as the market reacted to the Fed policy message from a day earlier. So why is it that at exactly 4:30 a.m., at the exact moment that the Bank of Japan started to intervene to save the yen, we saw the 10-year spike, the 20-year spike, and the 30-year spike? Again, right at the exact same moment of the intervention. Further than that, let's take a look at some numbers. Altogether, foreign institutions currently only have about $295 billion in this reverse repo facility. That's all central banks combined. It's just not a heavily used product, at least at the moment. However, some unnamed Wall Street strategists estimate the Bank of Japan has more than $110 billion in this reverse repo facility. That means that just the Bank of Japan has over 1/3 of the total usage in this facility. Now, is that possible? Absolutely. But here's the thing. It's not published. At least nothing I could find has any details on which central banks have exactly which amount in these facilities. Instead, what I think is going on here is the selling of the longer dated treasuries here, but I don't think it's done there, and I don't think that's what will continue into the future if this gets to the point where the Bank of Japan really has to unload here. I think the Fed will step in with their other tool, the Repo Facility. So what we've been looking at so far is the reverse repo facility. We're going to look at the repo one. Reverse repo is the Fed says, hey, central banks, give me your cash, and when you need to, you can have that cash back. Repo is the exact opposite. The repo facility, the Fed says to central banks, hey, if we need to, we'll buy treasuries from you. Give us your treasuries, we'll give you dollars. Now, they never used to have this facility available for foreign central banks. Even their intervention in the repo market was unprecedented in September of 2019. Very few counterparties had direct access to the Federal Reserve in the repo market, but that all changed post March of 2020. In March of 2020, here you can see in March of 2020, a temporary FEMA repo facility was established. FEMA is Foreign and International Monetary Authorities. So in March of 2020, the Federal Reserve created this new repurchase agreement facility. In addition to this, they created a new one that would be available to all financial institutions and not just the few that had access to them before. So they broadened the scope of who was able to access the Fed for selling treasuries to them in order to get dollars. This facility allows account holders, which are central banks and other international monetary authorities, to enter into these repurchase agreements with the Fed. In these transactions, the account holders will temporarily exchange their treasuries for dollars. So just like the repo market here for domestic financial institutions, when there's a need for liquidity, like in September of 2019, you can give that collateral to the Federal Reserve and get your cash. Same thing for foreign central banks. This facility provides an alternative temporary source of US dollars for foreign official holders of treasuries so that they don't have to sell these securities in the open market. Again, because the Federal Reserve was anticipating here that at some point in the future, there would be a scramble for dollars and that central banks all around the world would start liquidating their holdings of treasuries in order to get their hands on the dollars they need. And right now, the dollar is above 114. The dollar is almost never this high. It was briefly higher than this in the early 2000s and then briefly higher in the early 80s, but spends most of its time way lower compared to other currencies. There is a scramble for dollars going on right now, and the Fed must have anticipated that at some point it might be necessary for them to provide a very easy way for the rest of the world to get their hands on dollars so that the rest of the world didn't have to dump treasuries onto the open market and spike rates up to 20-30%. Now, unfortunately, there are no data published about this repo facility at the Fed. Again, this is the Foreign and International Monetary Authority's repo facility, and while we can find data on the usage of their reverse repurchase facility, there is nothing published on the regular repo facility that was created in March of 2020, which means that either it's not being used at all right now, or from the start it was created to have no transparency so that nobody would know if the rest of the world started dumping treasuries through this facility. Because you can see it when it hits the open market, it jacks rates up. Supply and demand, that's what happens to bonds. Somebody sells, price goes down, interest rates go up. That's the way it works. But not if you're selling to a buyer who will just keep it off the market and buy it from you at a predetermined price that is separate from the rest of the market. It's like you can go sell your used iPhone for $600 on eBay right now, but you've got a buddy you know you can call that'll buy it from you at $800 and he just won't tell anybody. It's not going to move the market. You can sell them as many iPhones at $800 as you want, and the price on eBay will never change. Huge shout out to my buddy Nobody Special Finance. His YouTube channel is great. He's been talking about this as well. We've been talking about what's going on here. Give him a follow if you don't know him already. And as always, really appreciate you guys. Thank you so much for watching. Have a great day.